Good afternoon, ladies and gentlemen, and welcome to the ARIX Bioscience PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will notify you by email when these are ready for your review. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. I'd now like to hand you over to CEO Robert Lyne and Managing Director Mark Chin. Good afternoon.
Thank you very much, Jake, and good afternoon, everybody. Thank you for joining. So, by way of introduction to ARIX Bioscience, we're here to make a tangible difference to patients' lives, and we're doing that by generating superior returns for investors by investing in a focused portfolio of innovative biotechnology companies. These are all addressing areas of high-end need in healthcare. How we do this is by providing liquid access to private and public biotech companies. So we are a listed vehicle on the London Stock Exchange, an evergreen venture capital fund that operates by investing in a diverse portfolio of companies where they're developing breakthrough technologies and breakthrough treatments for patients. We see this as an area of growing need, both within developed markets and developing markets across the world. We do this by a transatlantic team with Mark Chin, my colleague here, who's based in New York, and a team here in London, sourcing opportunities across Europe and North America, where we see the most promising science. We have built to date a portfolio of 10 companies across various therapeutic areas. At the moment, the portfolio is a balance of public and private holdings. There are 4 public companies in the core portfolio, all of which resulted from IPOs of companies that we first invested in when they were private. In addition to that core portfolio of 10 companies, we've also developed a public opportunities portfolio at the start of this year. That was a response to some very challenging public markets that we've seen in biotech over the last 12 months. Whilst those challenging public markets hit the public valuations in our existing portfolio, we've also seen real opportunities for undervalued companies, where many of which we'd actually seen when they were private originally. And we can see that these companies have programs with real potential to deliver transformative treatments for patients. We therefore took the opportunity at the start of this year to invest in that portfolio, and that's something where we see real opportunity going forward over the next 12 to 24 months. As well as those public opportunities portfolio that we've put together, we are also targeting new investments into private companies. Those private companies are going to be mainly, we expect, in North America, also with potential for those to be in Europe as well. And those companies now, we're looking at opportunities where they have drugs that are in clinical trials, so already in humans, or in some cases in very late stage preclinical development where we know that they're going to move into the clinic. And these are companies where we see the potential for them to be delivering positive data from clinical trial outcomes in areas where we think Big Pharma has M&A interest, for the potential for these businesses to be bought, ideally while still private, although there is the potential they may move on to the public markets as well. So that's the sort of shape of the portfolio that we're building today and that we're working with from our existing portfolio. We show a breakdown here on this slide as well in terms of the NAV of the business. As you can see, we're very cash heavy at the moment, and that cash that we have on the balance sheet, over £130 million, all of that we can track back to exits from within the existing portfolio that have taken place since the company was IPO'd in 2017. We're proud to see that that has actually demonstrated the evergreen potential of our model, which is what we were setting out to do when ARIX was first IPO'd 5 years ago. So here we have the current board and team of ARIX Bioscience. So there's myself as the CEO, and there's Mark Chin on the investment side as our managing director. We're supported by a strong and experienced board that's spread across the US and the UK. And also we have very great support from Felix Breyer, an associate of ours here in London as well. And beside that, we also have an operational team that then supports the business more broadly. So coming back to the sort of starting point as to the opportunity that ARIX is here to exploit, I think, as everybody will know, healthcare spending has only been rising both in absolute terms and relative terms to GDP. And we can see here the enormous amount of value and that is spent on healthcare alone. So in the US, for example, this is now at $4.1 trillion a year. Globally, a lot of this value that we see is also now being spent in therapeutics, so in drugs as well. And so for us at ARIX, out of this very large market, what we're looking to focus in on is this spend on drugs that we've seen increase dramatically over the last 20 years. And as we can see here, that spend is really concentrated in North America and Europe. And so that's why we see those as the core markets, both for sourcing opportunities, but also as to where drugs are going to get approved and where we're going to get high reimbursement levels. So out of this very large market for spend on drugs, what we look at is where those drugs actually came from when they were being developed. And over half of those were developed by independent biotechnology companies. That's where they first began. Very often in our business, independent biotechs will start early development of companies, and they will start these trials and a lot of clinical development on an independent basis, get it to a certain stage where it's showing promise, that it's demonstrated that there aren't any concerns around safety, and that there's actually a drug that is operative and is doing something and looks like it may have positive effect. And at that stage, there's often a lot of potential for big pharma to come along and buy these independent biotechs and then take the drugs forward to market. So for us, this is a sweet spot we see where independent biotechs are taking high-risk bets in terms of developing new treatments, but they will get them to a certain de-risk stage where big pharma will come in and buy, in our view, very ideally at a very significant uplift to the value that was put into those businesses to date. And we've seen that consistently over the last 10 years. So on average here, as we can see, about $150 billion is spent every year by big pharma buying biotechs to gain access to these early stage drugs and to replenish their pipelines. So for us, that's the market that we're targeting when we're looking at making investments in companies where we see that there's a high unmet need in the areas where they're seeking to develop treatment, but also crucially that we see that big pharma is active on an M&A basis and looking to buy in that area. So how do we do this? So when we're looking at sourcing opportunities, as I say, we look at a transatlantic basis. So we source across Europe and North America. That's where we see the best science. It's where we see the best teams. It's where we see the best investors. And so for us, that is the prime ecosystem in which we go hunting. In terms of the companies we look at, we focus only on cutting edge therapeutics. So best in class or first in class treatments. We've seen time and time again that it is those really breakthrough treatments where big pharma will pay the very high multiples that we're looking at when we would hopefully sell successful businesses. There are other opportunities in our industry where you might have Me Too drugs or drugs that are sort of similar or marginal improvements. And whilst there is a market for that, that isn't what we're in the business of. We're looking at these transformational treatments where we will get the highest selling price when we sell into big pharma. In terms of the stage of development, although we do some preclinical companies where they are not yet testing in humans, but they've got a clear pathway into the clinic in the near future, our primary focus now is actually on clinical stage companies, which are already dosing patients. For us, that is a sweet spot in terms of being somewhat de-risked from preclinical study work that they will have done, but also from an investment perspective, we can see time horizon where within 18 to 24 months, we would be looking at meaningful clinical data, which for us has the potential to drive uplifts in valuations, but more importantly, has the potential to drive M&A interest from big pharma. We source most of our deals through proprietary networks. So these are the networks that we have within this business. Very much in VC, it is about putting together a strong syndicate for a lot of the most promising companies. So in this case, and we'll see this with some of the examples we'll come to later in the presentation, our most recent investments have both been sourced where we were actually asked to take part in rounds. These are situations where the reputation and networks that ARIX has built actually allows us to be invited into the most promising opportunities that aren't marketed widely. And we see that as a big advantage of our business. Typically, we'd be looking to invest 5 to 15 million pounds per opportunity, with the potential that we may have further follow-on funding going into those companies if they need support in later funding rounds. For us, that's a nice way of spreading a number of bets across the portfolio and meaning we're not too exposed to any one opportunity. But it also means that we've got enough pounds at work that if there is a successful return, and we target typically 3 to 5x returns on the investments we make, when that money comes back through a successful exit, it's going to be a really meaningful amount of cash back to the balance sheet. So this slide sets out our thesis in terms of how we look at investment opportunities and the investment cycle that we look to target. So as I say, there's something of a sliding scale. It's not exact, but there is a strong sliding scale across development of drug development, where you look at the de-risking from a scientific and clinical perspective against an increasing valuation that we would have to pay to get into those opportunities. And for us, the window we set out here is the optimal balance we feel between a risk-reward basis. So we're looking, as I say, at companies that are going into the clinic, starting to get data, starting to show that actually these drugs are safe in humans and that they work in humans. And for us, this brings us not only into an interesting stage of clinical development, but it also means that these companies are starting to enter a phase where they can IPO. That's been more challenging in the last 12 months with the IPO markets being very, very difficult, particularly on the NASDAQ in the US, but that is something that will change over the medium term. So that's still a factor we consider. But more importantly, it takes these companies through to a phase where big pharma will start to take interest from an M&A perspective and potentially look to make acquisitions. And that's our absolute target. So setting out here on this slide, we've got a couple of examples, Serisia and Disc, that Mark will talk through later to explain how each of those companies fits within this thesis that we're looking at for the investment cycle. So these donuts here set out a description visually of the balance of the portfolio that we put together. We want to try and make sure that this is a diversified portfolio. However, we focus most of all on the opportunity of the science and the opportunity, frankly, for acquisition if then it is successful. And this is what leads us to this bias towards oncology that you can see here on the left of the slide. Oncology for us is an area where we know that there's obviously a high unmet need. We know that reimbursement rates for treatments are very high, and we know that pharma is acquisitive. Also, because the amount of research that's gone into oncology over so many years now, this is a disease that is pretty well understood. And so for us, when we're looking at opportunities, we can take something of a de-risked approach here, seeing that actually we think we know how the disease is operating, we think we know how the drug can work, and also we think we know who's going to buy it if it's successful. So we do have a bias towards oncology there, but also we do look at other therapeutic areas, rare disease, immunology, genetic disease as well, to maintain a balance within the portfolio. And each of those other disease areas also falls within those same criteria, that we understand something of how the diseases operate, and we also believe that there are buyers in that area if we get successful data from clinical trials. We also here have a balance between preclinical and clinical within the portfolio. This is something that we balancing somewhat over the last 12 to 18 months with much more of a bias towards clinical stage companies. For us, those are important because they are somewhat de-risked at that stage. We should have preclinical safety data, for example, that gives us confidence that these drugs are going to be safe and gives us indications that they may well be working in humans. So we have a de-risked element there. But also crucially, from a return profile, we then can have confidence that they're going to get clinical data within 12, 18, 24 months of our investments. And at that stage, we can start to see whether there's a drug here, whether it's working, and start to generate interest from big pharma for acquisitions. The final donut shows the balance between listed and unlisted. Inevitably, with the volatility of public market valuations, that balance does change over time. But at the moment, we are looking to try and maintain over time a bias again towards unlisted within the portfolio. So this slide sets out an overview of the 10 companies in the core portfolio that we have. As you can see, this sets out the stage of development. Most of them are clinical, as I was saying. There are a few, particularly some legacy companies that are preclinical there, but our priority is to move those into the clinic as soon as we can. Again, we have this balance between private holdings and those which have listed on NASDAQ. And also for information, we set out here the holding values that we currently have of the companies, as well as the ownership percentages that we have here. And I think it's important to note that when we come to value these businesses, we take a very conservative approach. So typically we will value the public companies are valued mark to market at the period end, so full year, half year for our published results, but also we do it on a monthly basis for the NAV that we release to the markets, and that is mark to market. So we feel that's very transparent. On the private companies, all of these holdings are rated either at cost as to when we went into these businesses, or where there's been a follow-on funding round led by a credible third-party investor that has priced the investment. We've taken that pricing that they put into the company. So we feel that these values, which feed through obviously into our NAV, are very robust. If anything, there may be something on the conservative side, But what we want to be is totally transparent about how we value these businesses. So I'll now hand over to Mark, who will talk us through a couple of slides on two investments which we did in the second half of last year, DISC and Ceriso, and explain how those fit into the rationale that I outlined.
Okay, thanks, Rob. So quickly, DISC Medicine is a company in what we call the benign hematology space. So that's non-malignant disease. The company, and I think as we think about how we put together our investment thesis, we focus on, a couple core tenets. Number one, teams that have done it before, good syndicate partners, areas where big pharma likes to acquire. Rob's mentioned this before. And then multiple shots on goal and hopefully very close to or in the clinic with the clinical proof of concept data within reach. So DISC is a good example of this. It was a clinical stage company when we invested. It has two assets, both in the clinic. One of the assets actually came from a big pharma, Roche, who had developed it for a different indication. That compound was bitopertin. That compound we will take into a different indication, but the existing clinical data set points to the fact that we've got a very high likelihood of clinical proof of concept with it. Importantly, the company founder and CEO is John Kiesel. He was actually the former CBO of Acceleron. And why that's important was Acceleron was most recently the most recent benign hematology company to be acquired by Merck in 2021 for $11 billion. And so that gives us at least, again, not that we would underwrite this deal to an $11 billion exit, but at least gives you a sense that big pharma is interested in this space. They like it. And, for us, at least, that gives us a good rationale for developing drugs. We invested $11 million in a $90 million Series B back in September. The financing was led by OrbiMed and included Janus and a number of other really high quality venture names. Importantly, as I think Rob had pointed out, we are active investors, and so we hold a board seat today. And importantly, the lead compound 0974 is currently in a phase 1 dose escalation study. It's demonstrated very early safety as well as hints of efficacy, and that positive data will be read out over the next 3 to 6 months. Additionally, the second compound, the Roche compound, is entering clinical trials as we speak. And we're working very closely with the management team there to expand the clinical development of those programs, as well as look at other clinical programs that we could bring into the fold. The second company, Ceriso, kind of going back to the tenets we talked about, ticks a number of boxes. I think number one, and most importantly, the company is led by Kira Kennedy, which is a former CEO of an ARIX portfolio company called Amplix, which was acquired back by Pfizer in 2021. That deal returned capital to us, as well as potential for 3x if milestones are read out. At the end of the day, as we said before, we believe in investing in teams that kind of have done this before. This is actually Kira's second company that has been acquired, so she's got a serial track record. This company is in a very interesting space of what we call autoimmune or INI, as I call it, inflammation immunology. It's a very hot area for pharma. There's been multiple billion-dollar takeouts by Pfizer, BMS, Merck, and it continues to be an area of interest. The drug here has actually been in humans before. Again, going back to this concept of being very close or having been in the clinic. Half of the drug had actually been in the clinic in a prior incarnation. We're taking a next generation version of it forward. And we co-led the Series A there with a group called NEA, a large venture group here in the United States. We hold both a board seat and an observer seat for this deal. Importantly, going back to the use of proceeds and what are we getting from our dollars that we're putting in, this funding will bring the lead compound into early clinical proof of concept. The drug will be in the clinic likely by the end of the year, and we should get very early readouts of how it looks in the early part of next year. So this is a little bit of an eye chart. I think the key takeaway here is really there are a lot of catalysts, I think is the short answer. And so in addition to both DISC and Ceriso, Aura has a number of readouts for both two different products. One is a suprachoroidal injection and the other an intravitreal injection. Both of those data sets will read out in the second half of this year. or as a public stock that we own quite a bit of at this point. I have a lot of confidence in the company. Kind of going back again to a similar discussion that we've talked about, one of our former company CEOs, Dave Johnson, who was the CEO of Velos, is now the chairman of the board at Aura, and gives us a lot of confidence that the company is being well run and managed. We have a high degree of confidence that that data set will look good. Second company, which is a private company, is Artios. They've got 2 programs in the clinic in dose escalation as we speak. Again, very similar to the prior companies. We have a lot of confidence that that data set will unlock value for the company over the next kind of 18 to 24 months. Below that, we have Harpoon, which is a public name. There's a very rich data set for 2 clinical programs that should read out at the end of this year and the beginning of next year. And we, again, feel very confident that despite the public market downturn of a number of public names, this one continues to perform because, again, the drugs work in patients, which is what we're really shooting for as investors. And then Rob touched on this at the outset. So the public opportunities portfolio. So we as a evergreen or patient, or however you want to view us as a venture capital firm, but we have the ability, I think, to play in a lot of different sort of sectors of biotech. And what we realized was the downturn of the XBI, as we call it, has really provided us an interesting opportunity from both a public market, but also from the private side. So we looked at about probably 40, 50, 60 companies that have IPO'd over the past couple of years, and had seen those on the private side and realized on the public side, we had seen a lot of these names down 40, 50, 60, 70% from its highs. And importantly, a lot of these companies we had seen on the private side where the valuations were, well north of where we're sitting today, yet we've got 3 more years of data around the companies. Oftentimes these companies have clinical proof of concept, yet had been battered by the public markets. And so we made a decision as a group to put anywhere from 5 to 10% of our NAV into positions, small positions in a number of different public biotech mid-cap companies. Ones, again, that we know from the private side, areas that we know well, disease and indications that we've done work in. And importantly, these are well-funded companies. Almost all of them have capital into 2024 or 2025, trading at negative enterprise values, and importantly, have already demonstrated clinical proof of concept or clinical milestones that are helpful, and have a number of additional milestones reading out in the next 6 to 18 months. And kind of lastly, to wrap up, and this is for folks that are new to the ARIX story, it's important to highlight kind of why are we doing this? Like, what are we doing this for? And we invested in a company called Velos Bio back in October of 2018. This was kind of, at least for us, one of the seminal deals that really shows what the power of what we do is really about. It was a company that we co-led Series A with another group called Sofinova Ventures. We were on the board there. And importantly, the company is developing what we call novel antibody drug conjugates for both hematological malignancies as well as solid tumors. Importantly, as when we first invested in this company, the CEO, Dave Johnson, who I mentioned before, who's also the chairman of Aura, was a serial entrepreneur. He had done this before at 2 companies before. And, again, this was a deal that had a very, very short path to the clinic. We were 3 months from IND, as we call it, which allows us to test in humans. The $60 million financing that we did as part of the Series A basically brought the company into the clinic, demonstrated what we call proof of concept, where we had responses in tumor responses in both refractory DLBCL and mantle cell lymphoma, which are 2 hematological malignancies. And in July 2020, we completed another Series B financing to take the company further into the clinic. And then shortly after that, Merck stepped in with a $2.75 billion acquisition in December of 2020. This deal is an example. We owned, again, anywhere from 8 to 10%, depending on the different time points that you looked at ownership, but generated gross proceeds of $187 million. And importantly, it was a 12.5x on our capital. And so Again, not every opportunity would look like this. Obviously we shoot for returns that are kind of 3 to 5x, but it's an example of what can go right in terms of our portfolio. And I think this slide really highlights that at the end of the day, any one of our companies can get an offer at any time. And we're obviously very careful in how we do valuations based on structured guidance from our auditors. But this is an example of, we were, in the Series A, we had a post-money valuation of 100 million. The Series B was 375. And in the short span of 4 months, we were acquired for 2.75 billion. So, again, we never guarantee that this could happen with any of our companies, but it just goes to show that even on the private side, a lot of these valuations, they're marked to the previous financing, and oftentimes have this kind of asymmetric upside in terms of the value that they can create. And so this is just an example of what we're sort of playing for in our portfolio.
Thanks, Mark. So just looking at the numbers of the business, as I outlined earlier, this breakdown shows how we value the NAV. So it's a majority cash at the minute, and this is the result of proceeds that have come from the portfolio, Velos, and other exits we've had since inception. There's a quarter of the NAV is held in private companies, and these are valued, as I said earlier, to the most recent funding round. So we aren't, with any of the companies at the moment, taking any kind of subjective view of the valuation here as to what we think they're worth. As Mark said, when we hold these companies at private valuations, it's on the basis of the last funding round, and that was the case of Velos. And then, as we saw with Velos, positive data was coming through, and there was far more M&A interest, and it was then acquired for a multiple of what we were holding it at. So, that is always possible. We don't know as and when those things are going to come. These companies are bought, not sold. But at the moment, for us, the private companies, we're holding them at those private last funding round or our cost for us. And then the remainder of the NAV is 16% is in the listed holdings, which are all marked to market on a monthly basis for our unaudited NAV. So looking at this slide, we put this together to give a demonstration of actually what the core portfolio can do and what we've achieved here at ARIX since IPOing 5 years ago. This slide sets out the money that's gone into our core portfolio, and then the value that has generated, both realized and unrealized. As you can see, there's been quite an increase in terms of the funding that went into the portfolio as we raised money at IPO, and as we raised further funds in March 2018. And that investment so far has generated value of nearly 320 million from 222 million in. So the core of our business has generated an incredible amount of cash, but also unrealized value sitting on the books as at year end. However, if we turn to the next slide, we'll see that, of course, and shareholders who've been with the story will know this, not all of that value necessarily is translated through into the NAV. And you'll see, obviously, that 319 million figure, there is obviously a difference down to the 255 million, which is the audited NAV at year end. And that delta is explained largely by quite a lot of leakage that occurred in the business when it was initially set up. There was a very high cost base, and there was quite a lot of investments into what we now view as non-core activities outside of this core venture portfolio that we've been describing. So certainly since the board was reformed and since I took over as CEO last year, a priority has been to get the cost base down and get those costs under control, and to make sure that we are focusing our activities and our capital solely on the core venture portfolio, which is what our business is about and what's generated money for us. And going forward, as we continue to see that value creation that we see as possible within the portfolio, our aim is to capture much more of that for shareholders by ensuring it stays within the business and translates into NAV and a NAV per share. So in summary, where we are now as a business, we have a very significant cash pool generated from exits that the business has achieved since inception. We've got a lot of cash runway, both to run the business, but more importantly, to invest further and expand the portfolio. We're trying to keep costs down as low as we can. We're targeting these at or below NAV of 2% of our NAV. Obviously, as our NAV fluctuates, that has an impact on that, but that is our long-term aim in terms of maintaining a proportionate and necessary cost base of the business. We're seeing within the portfolio multiple opportunities for positive data readouts in the future, which we hope to see, as Mark was outlining earlier. And we're also maintaining strong networks within the venture community in the US and Europe to ensure that we can continue to see the most promising opportunities coming into us, that we can look to decide whether we fund these or not, and where we allocate our capital to generate significant returns in the future. In terms of our financial targets, our overall target is generating a double-digit IRR, and we measure that ideally through an NAV per share. So double-digit NAV per share growth on an annual basis is what we're targeting. As supportive targets, we're looking at 2 exits and 2 additional IPOs, all measured over a 36-month period. For us, IPOs, they're not exits in themselves, they are funding events, but they do provide liquidity and they do provide some validation of the opportunities here. So we see those IPOs as indicative of a strong portfolio, but really the focus is on exits, and overall the focus is on this double-digit NAV per share growth. So thank you very much for your attention so far. We'll now turn over to Q&A.
Robert, Mark, that's great, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while Robert and Mark take a few moments to review those questions submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Robert, Mark, as you can see, we have received a number of questions throughout today's presentation, and thank you to all the investors for submitting their questions. If I could please just hand back to you just to run through that Q&A tab, and where appropriate to do so, if you could please just read out the questions and give your response, and then I'll pick up from you at the end. Thank you.
Certainly. So one of the questions we've had here is, are you finding opportunities to increase your holdings in portfolio stocks, i.e. from distressed sellers? And that's a very interesting question, actually, because we certainly have found on the public markets, obviously, the valuations have really come down over the last 12 months. For us, in some cases, that's connected to negative clinical progress, but in the vast majority of cases, it's simply a broad shift in the value of the market. And for us, that sentiment has clearly changed, but actually the underlying value of the drugs hasn't. So there is certainly the potential we've seen in some of the public stocks where we may be looking to actually increase the holding if we feel that there's still confidence in how that company is performing and how the data is going to read out. And there is a ready market, obviously, on the NASDAQ for those shares. On the private side, it's interesting because a key criterion that we look at when we're investing is actually very strong syndicates for the companies we go into. So we put together these private funding rounds. They'll always be syndicated, and we syndicate really almost exclusively now with the top tier investors in Europe and North America. What that means is that these companies are actually very well funded and very well supported, because all of us, when we go in, are looking at a fundamental thesis of the business, that we believe in the science, we believe in the team, we believe they can generate positive clinical data. For that reason, we actually haven't seen much opportunity for distressed secondary selling within the private companies. There are other businesses which, to be perfectly candid, maybe slightly weaker companies with slightly weaker syndicates where you are seeing secondary opportunities. But within the existing portfolio, the strength of those businesses and the conviction of our co-investors and the strength of those co-investors means that there isn't at the moment an opportunity for any distressed secondary selling within the portfolio. I think there's another question that's come through saying investment in public markets of 5-10% of total NAV, given easy access, availability and opportunity, isn't that low? I think that's a very fair question. It's something that we do keep under review at the moment. Part of when we've always been looking to set up the business and set up the portfolio is to achieve balance. And we're very conscious that at the public markets, there's an awful lot of volatility there. And we already have quite a lot of public exposure in terms of the listed companies, which were previously private, but IPO'd onto the NASDAQ. So although we're only looking at 5-10% of our total NAV at the moment in those public companies in the Public Opportunities Fund, also when we're looking at our overall exposure, we're adding on to the sort of exposure to public markets, our public companies in the core portfolio, and bearing in mind that at this stage, with still over half the NAV in cash, you're actually looking at a very large percentage of the invested cash exposed to public markets. So overall, at the moment, we feel that 5-10% in this liquid Public Opportunities Fund is the right number, but it's certainly something that we keep under review. Again, another question on that similar, I think, allocation point. London listed biotechs are even cheaper than NASDAQ. What opportunities do you see there? Why not allocate beyond 10% of NAV to public markets? So I think similar question. It's certainly something we take on board. As I said, we do have quite a lot of exposure to the public markets because of the existing venture positions as well. We do see very cheap valuations on the London exchange and also on certain other European exchanges as well. However, for us, we're really about the greatest quality opportunities. And for various reasons, over the last 5 years to 10 years, the strongest opportunities from Europe have listed on NASDAQ. And so the reality is when we're looking at the strongest teams, at the strongest clinical programs, at the greatest likelihood of acquisition by big pharma, we see those companies at the moment on NASDAQ almost entirely. There are some in Europe, and we do look at that, but I expect there'll always be a strong bias to NASDAQ. And that's a result of the fact that for various reasons over the last few years, the strongest private companies in Europe, including the UK, have all gone to NASDAQ to list. And so that's where we see the greatest potential. There's a technical question. Somebody's come in for a US person. Would you be viewed as a PFIC? I'm afraid the answer is yes. It's something we've looked at many times and recognize that does present some challenges for any US taxpayers who may be looking at investing in us. However, there are ways that the PFIC issue can be mitigated depending on whether people are investing through tax advantaged or tax exempt vehicles. So that's something we'd encourage people to explore. But from a technical perspective, yes, we are a PFIC. Mark, it may be helpful. There's a question here we've had since our last update for full year results on the analyst call. There was a request here for an update on the biotech funding landscape. What are you hearing from your companies on the ground about capital requirements and private valuations?
Yes, I think, look, it's been kind of widely known that private valuations usually lag public valuations. I think we have been increasingly conservative and cautious in this environment on the private side, which is why, in the first 6 months of the year, we haven't done a deal on the private side. We are finding that, look, a number of companies are well funded and they received funding, over the past 3 or 4 years, and when the cycle was very, prolific and cost of capital was low. I think what we're starting to see that's now materializing is many of those companies are coming up for financing, and the post monies of those companies are fairly high. Not surprised, given that they were pegged to public market valuations that have now come down quite a bit. So there is a little bit of a reset that's happening on the private side, as cost of capital has gone up, as companies need to refinance, and what we're seeing essentially is most deals are being done flat. And some even down to the last round of financing. And, you're starting to see the reset of the public markets happening in the private markets. And so I think that offers us over the next kind of 18 to 24 months, a really interesting and unique opportunity, since we do have a lot of cash, and being able to invest in deals at, valuations that are 50 to even 75% less than what we had previously seen in the upturn, from 2018 to 2021. And so I think there's a real opportunity here to get a number of really high quality companies into our portfolio at really reasonable and even very cheap valuations. But again, it's a slow process, as the reset on valuations only really happens once a company needs to be refinanced, right? And so that's kind of the leading edge, is really the public then to the private side.
Thanks, Mark. Another question's come through about how the public opportunities portfolio is performing. So we haven't yet released a breakdown of that individually, but to date, it is slightly down overall. But interestingly, what we've seen so far, and that largely has tracked the continued decline and volatility we've seen in the XBI, and that's the NASDAQ Biotech Index, which we feel is the closest index tracker that we look at when we look at public market performance for us. So it is slightly down to date, but crucially what we've seen is where there's actually been data and where there's been strategic activity with some of the companies in that portfolio, we've seen significant uplifts. So there are 2 or 3 companies already that are up 20, 30, 40, 50% within that portfolio. And those are the kind of dramatic re-ratings that you can get with some of these biotech companies. So it's something where, for us, we recognize that there's volatility in the public markets, and going in with that, we recognize that would expose us to volatility. But always it was about the fundamentals of these companies. It was about applying the same analysis and the same rigor that we have on the private side, in terms of, are these companies fundamentally that can deliver positive clinical data from their trials, where we think there's going to be M&A activity and strategic interest from buyers. So those criteria still hold for those companies, and where we've started to see that thesis play out, we've seen very substantial gains. In other companies, we've seen, still significant reductions in their current mark-to-market valuations, which we've reflect the shifts in the markets we've seen more broadly. But whilst those are ahead of data, we have to hold our nerve there. What matters for us is what happens when the data comes out, what happens when there's strategic activity, and what happens when that value comes through. And for us, that portfolio overall, we're looking at on an 18 to 24 month time horizon. And so that's the kind of timescale that we're looking to really judge the portfolio. So we're encouraged that we've seen some potential there. I mean, the thesis is starting to work with some companies, but we haven't yet overall seen the big delivery in value that we still think can come in due course. And there's another question here about the disconnect between the market cap and the substantial cash pile and assets. Why do you think there is such a disconnect? Certainly, you know, obviously the share price is something that we can't control. We can control the NAV and we can control the performance, and we try and communicate as best to markets and to investors through fora like these to try and explain where we see the value. There's been a big shift, I think, risk off generally in the public markets, and we've seen many peers as well come down very substantially since the start of the year. And this also reflects, I think, generally the retreat we've seen from this sector in the US, which has hit a lot of the public valuations and has inevitably hit our NAV. But for me, what gives us confidence going forward in the future is that the reimbursement rates, you know, the amount that are paid for successful drugs, that's not changed in the last 12, 18 months. So drugs that 18 months ago were hopefully going to be billion-dollar drugs, they are still hopefully billion-dollar drugs today. So for us, the ultimate value in the sector hasn't changed. We are going through a challenging time, but we feel that that's an opportunity both for retail investors into ARIX, but also for us as an investor ourselves into private opportunities and public opportunities. And the long-term trends that I was talking about at the start of the presentation, those are still holding, and I don't think those are going to change. Increasing healthcare spending, increasing spending on drugs, an increasing need for big pharma to populate their pipelines with new drugs that they're getting in from biotechs. At the start of this year, it was estimated that the 20 largest pharma companies in the world had about $350 billion of cash between them. So these are incredibly cash-rich organizations, and they will need to deploy that value over time. And so that's where we see the opportunity. And when we see that M&A activity resume off the back of positive data, cash coming into ARIX, that's what we've seen in the past. We saw it with Velos, which had a transformative effect on our NAV, but also, frankly, on the market capitalization of the business as valued by the markets. So we see those potentials still there. We think that the fundamentals haven't changed, and the potential for the re-rating we've seen in our stocks, but also, frankly, in ARIX in the past, we very much see that as potential for happening again in the future. I think that's the end of the Q&A, unless there's anything that anybody else would like to submit.
Absolutely, Robert. Mark, thank you very much indeed for taking the time to address all of those questions that came in from investors this afternoon. And of course, if there are any further questions submitted today, we'll make these available to you immediately after the presentation has ended for your review. And ladies and gentlemen, we'll publish all those responses where it's appropriate to do so on the Investor Meet Company platform, and you'll be notified by email once they're ready for your review. Robert, perhaps for redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Certainly. Well, look, thank you, first of all, everybody, for your attention today. It's a great opportunity to have this direct connection to retail investors. We're very pleased to have our inaugural presentation on Investor Meet Company. Very much looking forward to doing this again. We've got some contact details here for our mailing list, but also for any direct queries that anybody wishes to send in. Just to recap at a high level, you know, what we're here for, and it's a fantastic business to be involved is generating really significant returns for shareholders through new treatments for patients. These are fundamental areas of the global economy that I think are not going to change. The demand is very much there. We see that the buyers are very much there, and we see that the science is there and the opportunities are there. And what we're doing day in, day out is working on these opportunities to build these companies, put capital in, develop new drugs, get indications that these drugs are safe, that they work, and then ideally sell them into pharma, take that cash back onto the balance sheet through an increasing NAV and reinvest that capital to do so again. And through that, we can see a clear path to very strong NAV growth. And we hope that will also, in due course, translate into value for shareholders.
Robert, that's great. Mark as well. Thank you very much indeed for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of ARIX Bioscience PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.